Your credit score is decided by exactly 5 things, and I'm going to give you all 5 right now in order of how much they matter before I explain a single one. 1. Paying your bills on time. That's the biggest factor by far. 2. How much of your available credit you're using. Keep it low. 3. How long you've had credit. 4. The mix of credit types you have. 5. How often you apply for new credit. Less is better. That's the whole formula. There is no secret, no trick, no company you need to pay. Master those 5 and your score climbs. Ignore them and it doesn't. Everything else you've heard is noise. The rest of this video breaks down each factor, tells you the fastest one to fix, busts the myths that quietly hurt people, and gives you a realistic timeline, because anyone promising to fix your credit overnight is lying. Let's get your number moving. I'm Mr. Finance. I take the money topics everyone stresses about and hand you the actual mechanics. If that helps, subscribing takes one tap. Now, why this number rules your financial life? Before we fix it, understand what it is. Your credit score is a 3-digit number, usually between 300 and 850, that tells lenders one thing: how likely you are to pay back money you borrow. A high score says this person reliably pays. A low score says this person is a risk. That's all it measures: trustworthiness with borrowed money. And here's why it quietly runs your financial life. That number decides whether you get approved for a mortgage, a car loan, or a credit card, and more importantly, at what interest rate. A person with an excellent score and a person with a poor score can borrow the exact same amount for the exact same house, and the low score person pays tens of thousands of dollars more over the life of the loan purely because of that number. It reaches beyond loans, too. Landlords check it before renting to you. Insurance companies use versions of it to set premiums. Some employers glance at it. A good score can quietly save you a fortune and open doors. A poor one can cost you money and choices every single month, often without you even seeing it happen. So this isn't an abstract game. Improving your credit score is one of the highest value financial moves available to you, because a better number lowers the price of nearly everything you'll ever borrow. A 100-point improvement can be worth more than a raise. That's why it's worth understanding the 5 factors properly, so let's take them one at a time, starting with the one that matters most. The single biggest factor in your credit score, around a third of the entire thing, is your payment history. Do you pay your bills on time? That's it. Nothing moves your score more up or down than this. Here's the brutal asymmetry you need to understand. Paying on time builds your score slowly, but a single missed payment can drop it sharply and stick around for years. One 30 days late payment can knock a good score down significantly, and it can linger on your report for up to 7 years. Months of good behavior can be undone by one forgotten bill. That's why this factor deserves your fiercest attention. The fix is refreshingly simple. Never miss a payment, ever. And the way to guarantee that isn't willpower. It's automation. Set every bill you can to autopay at least the minimum amount automatically. That one setup removes the human error that causes most missed payments. You're not trying to be disciplined every month. You're removing the chance to fail. One honest clarification, because it trips people up. Paying on time means at minimum paying the minimum due by the date. Paying the full balance is even better for other reasons we'll get to, but for this factor specifically, what matters is that the payment lands on time. If money is tight, always at least make the minimum on time. Protecting your payment history is more important than almost anything else you do with credit. This one factor, handled perfectly, does more for your score than every clever trick combined. The second biggest factor, nearly another third of your score, is called credit utilization. It sounds technical, it's simple. It's the percentage of your available credit that you're actually using. If you have a credit card with a $10,000 limit and you're carrying a $9,000 balance, your utilization is 90%. And that terrifies the scoring model because it looks like someone stretched to their limit and struggling. If you're carrying only $500 on that same card, your utilization is 5%, and that looks like someone comfortably in control. Same card, wildly different signal. The general guideline: keep your utilization below 30%, and below 10% is even better. This is often the fastest factor to improve because, unlike payment history, it updates quickly. Pay down your balances, and your score can jump within a month or two, no 7-year wait. If you want a quick win, this is usually where it comes from. There are two levers here. The obvious one, pay down your balances so you're using less. The less obvious one, increase your available credit. For example, by asking for a credit limit increase on a card you already handle well. If your limit goes up and your spending stays the same, your utilization drops automatically, and your score can benefit without you paying down a cent. Just don't treat a higher limit as permission to spend more. That defeats the entire purpose. And a clean honesty anchor. The goal isn't to game a number, it's that low utilization genuinely reflects healthy borrowing. Use credit lightly, pay it down, and this factor takes care of itself. The remaining 3 factors matter less individually, but together they still shape your score, so let's handle them quickly and correctly. Factor 3. The length of your credit history, about 15%. The longer you've had credit accounts open and in good standing, the better. This rewards patience and quietly punishes one common mistake, closing your oldest credit card. That old card is anchoring your history. Closing it can actually shorten your average account age and lower your score. So generally, keep your oldest accounts open, even if you rarely use them. Time is doing free work for you. Don't undo it. Factor 4. Your credit mix, about 10%. Scoring models like to see that you can responsibly handle different types of credit. Say, a credit card and an installment loan like a car or student loan. You should never take on debt you don't need just to improve your mix. That's backwards and expensive. But it's useful to know that a healthy variety, when it happens naturally, gives your score a small lift. Factor 5. New credit and hard inquiries, about 10%. Every time you apply for new credit, the lender does a hard inquiry, which can ding your score a little, temporarily. Apply for many things in a short span, and it looks like you're desperate for money, which lowers your score. The fix is simple. Only apply for credit when you genuinely need it, and don't open several new accounts at once. Space out your applications, and this factor stays quiet. None of these 3 will transform your score alone, but avoiding their traps, don't close old cards, don't chase unnecessary debt, don't apply for everything at once, keeps them from silently working against you while you focus on the big 2. Let me kill the myths that actively damage people's credit because believing these costs real money. Myth 1. Checking your own credit score hurts it. False. Checking your own score is a soft inquiry and has zero effect. You can and should check it regularly. Many banks and free services show it at no cost and no risk. Only lender hard inquiries ding you. Watch your own number freely. Myth 2. You need to carry a balance to build credit. This is the expensive one. You do not need to carry debt or pay interest to build a great score. Using your card and paying it in full every month builds excellent credit. The activity is reported either way. Carrying a balance just means paying interest for nothing. Pay in full, always. Your score is just as happy and your wallet far happier. Myth 3. Closing unused cards helps. As we covered, it often hurts. It can raise your utilization and shorten your history. Usually, leave them open. Myth 4. Your income is part of your credit score. It isn't. A high earner can have a terrible score, and a modest earner can have an excellent one. The score measures how you handle credit, not how much you make. Behavior, not salary, builds the number. That's actually good news. It means anyone, at any income, can build great credit by handling it well. Here's the honest part. Nobody selling a quick fix will tell you. Improving your credit score takes time, and that's by design. The number is meant to reflect a pattern of behavior, and a pattern can't be faked in a day. Some things move fast. Lowering your utilization by paying down balances can lift your score within a month or two. But the big engine, a history of on-time payments, builds over many months and years. If you've had past misses, the good news is that their impact fades over time as you stack up good behavior, and most negative marks eventually drop off entirely after about 7 years. So beware anyone, any company, any ad, promising to fix your credit overnight for a fee. The legitimate moves are ones you can do yourself for free. Pay on time, keep balances low, don't close old cards, and apply for new credit rarely. Do those consistently, and your score will climb on its own. The only real credit repair is time plus good habits. That's not the answer people want, but it's the one that actually works. Let me turn all of this into 3 concrete moves you can make in the next few days, because knowledge that stays in your head never lifts a single point. Move 1, tonight. Turn on automatic payments for every bill that offers it, set to at least the minimum. This one action protects your most important factor, payment history, forever and removes the single most common way people wreck their score. 10 minutes now, guarded for life. Move 2, this week. Check your actual credit score and report. Most banks and several free services show it at no cost and with no ding to your score. You cannot improve a number you've never looked at, and you may spot an error or an old account dragging you down. Know where you stand before you try to move it. Move 3, this month. Look at your credit card balances, and if any are above 30% of the limit, make a plan to bring them down, starting with the highest utilization card. This is your fastest possible win. The number can respond within a billing cycle or 2. Pay down what you can and consider requesting a limit increase on a card you already manage well to lower utilization further. 3 moves. Automate payments, check your score, lower your balances. Do those. Keep them up, and you've set the 2 biggest factors working in your favor on autopilot. Everything else is just letting time do its job. So how to improve your credit score? Pay every bill on time, always, and automate it. Keep your credit usage low, ideally under 10%. Keep your oldest accounts open. Don't chase unnecessary debt or apply for everything at once. And check your own score freely. It never hurts. Master the 2 big factors, on-time payments and low utilization, and you've handled the bulk of your score. Add patience, avoid the myths and the number climbs. No fees, no tricks, no company required. Just 5 factors and the discipline to respect them. 5 factors decide your entire credit score, and 2 of them do most of the work. Pay on time and keep your balances low. Everything else is supporting cast and myth-busting. There is no secret the credit repair companies are hiding. The real repair is free, and it's just consistency over time. I won't pretend it's instant because it isn't, and anyone who says otherwise is selling something. But every one of these moves is in your own hands, costs nothing, and compounds. A year of quiet, boring good habits can lift your number enough to save you more than a raise would on your next car, your next apartment, your next home. I'm Mr. Finance. Subscribe if you want more of this. Plain mechanics, real numbers, no hype. And tell me in the comments, what's your credit score right now, and which of the 5 factors do you think has been holding you back the most? I read every single one.